Hey everyone, welcome back to Sip and Talk. So today we're looking at the global economy. And based on what we've been seeing, it feels like we're navigating some pretty choppy waters.
Yeah, definitely feels that way. Trade tensions, potential big risks down the road, currency shifts. It's a lot.
It is. We're going to try and unpack the latest on trade, those looming risks for, say, 2025, and how currency movements, especially the dollar, are shaking things up.
Right. The mission here is to cut through the noise, help you get a clear picture of what's happening, and crucially, why it matters.
Let's get into it.
Okay, first up, this whole tariff tango seems to be a major driver for markets right now, constantly shifting.
It really is. I mean, look at the U.S. and China. The current average U.S. tariff on Chinese goods, it's sitting around 55%.
55? Wow. How does that compare?
Well, the average U.S. tariff on goods from other countries is only about 10%. So yeah, it's a big difference.
Huge. But still not that 145% figure that was floated earlier.
No, nowhere near that hypothetical level. But this 55%, it still has an impact. The estimates we're seeing suggest it could shave about 1.4 percentage points off U.S. GDP growth.
Okay, so a noticeable drag, but maybe not a full-blown recession trigger?
That seems to be the consensus, yeah. Not recession territory. But for companies, they've been absorbing these costs. But the expectation is they'll start passing more of that on to consumers, probably noticeably in Q3.
And then there was President Trump's statement, right? About a trade deal framework with China being completed.
Yes, that came up. And some specifics were reported, too, things like China immediately supplying rare earths and magnets.
And the U.S. agreeing not to pull Chinese student visas seemed quite concrete.
Well, that's the interesting part. Almost immediately, you had experts saying, hold on, this looks temporarily unfinished.
Temporarily unfinished. Why the skepticism?
Mostly because of the lack of, actual detail. The specifics aren't really there yet. And critically, China still holds some very strong cards.
Like the rare earths you mentioned.
Exactly. They give them significant leverage.
And speaking of leverage, just as people were digesting that China news, boom reports that Trump threatened unilateral tariff letters to, 15 other countries?
Yeah, about 15 other trade partners. That definitely stirred the pot again, added a whole new wave of uncertainty.
And markets reacted how?
Pretty much as you'd expect. Global stocks took a dip. The dollar weakened a bit. We'll circle back to that later. And you saw money move into safe havens. Gold ticked up. VIX futures, which measure volatility, also rose. Investors clearly don't like that kind of unpredictability.
Okay, let's pause on those rare earths for a second. You said China has leverage there. Just how critical are these materials?
Oh, they're absolutely vital. China's dominance in this space is quite remarkable. We're talking about them controlling roughly 70% of the global mining.
70%.
And a staggering 90% of the processing. That processing part is key. It gives them immense power in negotiations.
And they've used this power before.
Oh, yes. Historically, tactics included things like keeping prices artificially low to discourage competitors, or using initiatives like the Belt and Road to secure mining rights in places like Africa.
So the U.S. sees this vulnerability.
Clearly. There's a big push now to ramp up domestic production. The goal seems to be achieving domestic supply within, say, 5 years.
Wow.
Through things like executive orders, funding initiatives, and fast-tracking permits for companies with promising sites. Like U.S. Critical Materials in Montana. They apparently have a site with a 9% grade, which is quite high for rare earths.
Are there other potential sources being looked at?
Yeah, places like Ukraine and Greenland get mentioned. But they seem to face bigger hurdles right now, maybe lower grades, lack of infrastructure, things like that.
The bottom line, these aren't just some obscure elements. They're crucial for
everything. Defense systems, aerospace, electric vehicles, AI chips, you name it. They're fundamental to a lot of modern technology.
Okay, bringing it back to the listener then. Why should you keep an eye on these tariff fights and rare earth supplies?
Well, think about it. Tariffs can mean higher prices for things you buy, especially electronics, cars. And if China restricts rare earth exports, that could disrupt the supply of technologies we all rely on. It's not just abstract policy. It impacts supply chains, potentially your costs, and definitely adds to market jitters.
Right. It's about the cost of goods, market stability, and even who makes the parts inside the tech you use every day.
Exactly.
All right, let's zoom out a bit now. Beyond these immediate trade headlines, what are the bigger potential risks lurking for the global economy, maybe looking out towards 2025? You called them unexploded bombs earlier.
Yeah, that felt appropriate. When you look at the analysis, several major risks consistently pop up. There's the potential for the war in Ukraine to escalate further.
Still a huge factor.
Absolutely. Then there are the trade wars we've just been talking about, but maybe widening. Also, high global debt levels, the big economic shifts happening inside China, the impact of AI.
Okay, wait, let's slow down. That's quite a list.
It is. And add to that, extreme weather events becoming more frequent, political instability in various parts of the world, and the ongoing struggles of the poorest nations who kind of missed the post-pandemic rebound.
Okay, let's tackle a couple of the really big ones first. Ukraine war escalation. What could that really mean?
Well, it's flagged as a top geopolitical risk for 2025. You see in places like the World Economic Forum reports. An escalation could severely disrupt energy and food markets even more than now. Think oil prices. Brent crude is already volatile. Some analysts think a major escalation could push it over $120 a barrel. That means higher inflation everywhere, slower growth, and it could easily push Europe especially towards recession.
And the second big one you mentioned, the broader tariff or trade war risk.
Right. We talked about the U.S.-China specifics, but imagine potential general U.S. tariffs of, say, 10-20% on many imports, plus maybe that's 60% on China.
That would almost certainly trigger retaliation, wouldn't it?
Almost guaranteed. And the result? Higher prices for consumers globally, more inflation, and real pain for export-heavy economies. Morgan Stanley put out some numbers suggesting a scenario like that could cut global trade volume by 5-10%.
5 to 10%, that's huge.
It is. And they also projected maybe a 1-2 percentage point jump in U.S. inflation, the CPI, and maybe 0.5% shaved off global growth. Plus, businesses would be scrambling to redo supply chains, adding costs, especially in sectors like automotive and electronics.
Okay, let's quickly touch on some of those other risks. High global debt, how bad is it?
It's pretty high. Global government debt is over 100% of GDP overall. The U.S. and Europe are carrying a lot. With interest rates up, servicing that debt gets tougher, raising financial stability risks. And don't forget, emerging markets, they owe over $13 trillion in U.S. dollars, according to the BIS. That's a major vulnerability.
And China's economic transition, what's the risk there?
China's trying to shift from relying on manufacturing and exports to more domestic consumption. It's a tough transition. And they've got internal headaches like the property sector issues and local government debt. If their growth slows more than expected, Bloomberg suggested maybe 4.5% in 2025. That reduces global demand for everything.
AI technology, we hear a lot about the benefits, but what's the risk?
Job market disruption, mainly, especially jobs involving routine tasks in manufacturing or services. McKinsey had an estimate. Something like 30% of jobs globally could potentially be automated by 2030. So 2025 could be a key year where we really start seeing that impact accelerate.
Extreme weather seems obvious, unfortunately.
Yeah, the economic costs are mounting. Damage to agriculture infrastructure, it pushes up food prices, pressures insurance markets. Munich Re estimated something like $200 billion in losses just from climate disasters in 2024. That trend seems set to continue.
Political instability.
Lots of elections. Policy uncertainty in Europe, Latin America, elsewhere. And of course, the U.S. political landscape always adds unpredictability, as groups like Eurasia Group often point out. It makes businesses hesitant to invest.
And finally, those poorer countries struggling.
Yeah, many nations, particularly in sub-Saharan Africa, according to the World Bank, didn't really recover post-pandemic. They're often burdened by debt, facing potential humanitarian crises. That instability doesn't stay contained. It affects global stability, too.
Wow. Okay, it really does sound like a minefield out there.
It's a complex picture, definitely.
But understanding these potential risks helps you see the bigger context, right? How might one of these or a combination affect your job security or the cost of groceries or even decisions about where you might travel or invest? It connects back.
It absolutely does. These aren't just abstract economic concepts.
Okay, let's shift gears one more time. The U.S. dollar. You mentioned it weakened a bit recently. How does the dollar's value shake things up globally?
The dollar. Its movements have really complex, widespread, and often contradictory effects. What's good for one country or sector can be bad for another.
So let's start with the potential upsides of a relatively weaker dollar. Who benefits?
Often, exporters outside the U.S. benefit. If the dollar is weaker, goods made in, say, Europe or Asia become cheaper for buyers using dollars. So think European car makers or Asian electronics manufacturers, their products become more competitive. The IMF has shown Eurozone exports tend to rise when the dollar falls.
Okay. Anyone else?
Yes, countries that import a lot of raw materials often get a break. Things like oil, metals, they're usually priced in dollars globally. So if the dollar weakens, the cost of those essential imports goes down their local currency, which can help ease inflation.
But you said it's not all good news. What are the downsides, the negative impacts?
Right. A big one is for companies or countries that borrowed heavily in dollars but earn their revenue in their own currency. That $13 trillion in emerging market dollar debt we mentioned, a weaker dollar should theoretically make it easier to repay. But if the dollar weakens too fast, or if their own currency also falls, it can actually trigger instability. Investors might pull money out, fearing defaults, leading to a nasty cycle of currency depreciation and capital flight. We've seen that happen.
Interesting. Any other negatives?
It can sometimes contribute to spreading inflation. If the U.S. economy is running hot while the dollar is weak, U.S. demand pulls in imports. But those imports cost more in dollar terms. Those higher costs can ripple through global supply chains.
What about at the company level? How does it affect specific businesses?
Well, for big U.S. multinational corporations like Apple or Microsoft, a weaker dollar is usually good news. Their overseas earnings translate back into more dollars on their balance sheets. Apple, for instance, has noted foreign exchange giving a boost to revenues at times. It also makes U.S. tourism cheaper for foreigners.
On the flip side,
bad news for non-U.S. companies that rely heavily on imports priced in dollars, maybe energy or key components. Their costs go up, squeezing profits. Japan, for example, sometimes struggles with higher import costs, contributing to trade deficits, even when the yen isn't super weak against the dollar. Plus, companies everywhere have to spend more time and money on currency hedging to manage the volatility.
Okay, and finally, how does the dollar's value affect broader trade and capital flows?
From a positive viewpoint, a weaker dollar could potentially help balance global trade, making U.S. exports more attractive, imports less so, maybe shrinking the U.S. trade deficit over time. It might also push countries to diversify their export markets. And if the Fed is keeping policy relatively easy alongside a weaker dollar, that can encourage investment globally.
And the negative view.
A sustained or sharp fall could cause capital to flow out of the U.S. seeking better returns elsewhere. It could also spark competitive devaluations, currency wars, where countries deliberately weaken their currencies. Brazil complained about this back in the 2010s.
Right.
And long-term, a persistently weak dollar could gradually erode confidence in it as the world's main reserve currency. We're already seeing central banks slowly diversifying their reserves away from the dollar a share. Is down to about 58.4%, a 30-year low, according to IMF data. They're moving into gold, other currencies.
Can you give a quick example of these dynamics in action?
Sure. Think back to 2020, after the initial COVID shock. The dollar index, the DXY, dropped quite a bit, nearly 12% from its peak. That period saw a boost for U.S. tech exports, like Tesla, NVIDIA. Money flowed into emerging markets, too. Taiwan's stock index jumped over 20%.
But there were downsides then, too.
Absolutely. That same dollar weakness, combined with other factors, contributed to worsening currency crises in places like Argentina and Turkey. More recently, say since 2023, the dollar hasn't been at its peak strength. That's helped China a bit with lower import costs and boosted profits for some European firms like LVMH as their luxury goods became relatively cheaper for dollar buyers, though they also face tougher competition from U.S. brands.
So, wrapping this section up, why should you, the listener, pay attention to the dollar's ups and downs?
Because it touches so many things. The cost of your next overseas trip, the price of imported goods at the supermarket, the performance of your investment portfolio, especially if you have international exposure. It all connects back to the dollar's value in one way or another.
Wow, okay. That really was a comprehensive look. Tariffs, rare earths, those big global risks, the dollar's ripple effects. Quite a journey.
It really highlights how interconnected everything is, doesn't it?
Yeah.
And just the sheer level of uncertainty that everyone, policymakers, businesses, individuals, is trying to navigate right now.
Absolutely. So maybe here's something to think about as you go about your day. With all these pressure points and potential shifts we've talked about, where might the unexpected opportunities actually arise? What could change in surprising ways because of all this churn?
That is a great question to ponder. Food for thought.
Indeed. Well, thanks for joining us for this deep dive. We hope it gave you some valuable insights to chew on.
I just want to give another shout out to Micky from Mickytolife. His channel is a treasure trove of inspiration, and he's a huge Sip and Talk fan.
Absolutely. Make sure to check him out and maybe even share your awesome podcast intro with him once you've created it.